I see some activity taking place and some chatting in there and people trying to get set up. So again, we'll just give it a couple more minutes. We are at 9:02 and I will start at 9:03. And I want to respect everybody's time this morning. All right, I think I'm going to go ahead and get started. First of all, let me say welcome to everybody. I'm Gail Letts, and I want to welcome you to this week's edition of Let's Talk. Let's Talk is a weekly program that will focus on topics of finance, business, career, and health and wellness, specifically designed for women, for professional women. But for those men who have joined us this morning, we are pleased to welcome you. Since COVID-19 took over our lives a few weeks ago, many women have talked to me about their personal finances. Many have worried that their savings and investments will be lost due to market volatility. Others have wondered if they should liquidate, selling off investments and moving to cash. Yet others have asked me if now is the time to invest and take advantage of low-price stocks. This morning, I'm pleased to welcome as our guest Roberta Keller, founder and CEO of Alexis Advisors. Roberta began Alexis Advisors in May of 2013, having worked in institutional money management on Wall Street. Roberta will talk about today's markets, putting them into historical perspective, and will offer some thoughts on personal financial strategies. There will be some time for Q&A at the end, but if you have a question during the presentation, please feel free to send it in using the Q&A button on the bottom of your screen. To begin today's program, we'd like to take a quick poll, which will show up on your screen. This will only take 30 to 45 seconds to complete, and this will help Roberta frame her comments to make the discussion as relevant and helpful as possible. Kate, if you'll put out the poll, please. And then Kate, when it looks like we've got the answers, if you could just show it for me. Kate, do we have the results of the poll yet? I'm seeing a question from Angie Melgren who's saying, I don't see a poll. Hit the poll button at the bottom. I believe that will be under, if it's not showing up, it'll show in under more. I will say this is relatively new technology to us, so if we're having a glitch, Roberta, can you see the poll?
I cannot, but she just asked me to stop sharing my screen, which I did. Um, and if we don't have, if it's not available, it's really not that urgent or important. It was more just out of interest.
All right.
Um,
Oh, here it is. Here's the
Here it
poll.
is. That
Whoops.
just popped up. It just popped up, Kate. And then it went away. There it is.
So it'll just take 30 to 45 seconds to complete. We got it and done. Good job, everybody.
Great. So Kate, we'll look at the results in just a second. This will take probably just a second.
Ah, here we go. Great.
Okay, great.
So it looks like the majority of folks who answered have heard of the bull and bear markets. We have 67% of the respondents wanting to minimize losses during a bear market as opposed to maximizing gains during a bull. And then what does the term manage risk imply? To smooth out the investment returns. Very good. So with all that said as a backdrop, Roberta, first of all, I'm thrilled to introduce Roberta Keller and just turn over the program to her. Roberta?
So let me go back and share my screen. So my name is Roberta Keller, and I want to thank Gail so much for inviting me to speak at Let's Talk. And I am really passionate about this subject of managing risk. I'm originally from Richmond, Virginia, but found myself in New York City thinking I was going to go back to school in architecture. I worked for an architectural firm and I was really pretty bored. So my dad said to me, well, why don't you go down and work on Wall Street? You're pretty good in math. And so I was like, okay. It was really, really not planned. But what that resulted in was about 10 years working in institutional money management. I worked on Wall Street, and then I worked for a hedge fund in Connecticut, and then in London for about 5 years, and ultimately returned to Richmond for a number of reasons, but one of which was to focus on an undiagnosed thyroid problem. So I got out of the industry and really found that the industry had impacted my health. I think it had contributed to some of my health issues. So I taught yoga to help get back on my feet, and realized as much as I loved it and had been practicing it for years, it wasn't going to pay the bills. So I went into consulting, which I loved, but the financial crisis hit, and I'm sure everyone on the call remembers that. And I just saw that a lot of individuals and families were getting what I considered less than optimal advice about managing through a very challenging period in the market. So I went back into the industry and worked with a gentleman for a period of time, and then started my business in May 2013. Alexis means helper, defender, advocate, and I really started this business as a way to support individuals, specifically women and their families. We work with plenty of men, but often it's through the women making the introduction. We offer planning, but really the impetus for me starting the business was this defender piece, was to help people better weather these kinds of bear markets. This is one of my favorite pictures, the fearless girl. I somewhat identify with this, with the bull on Wall Street and the fearless girl. There are not a lot of women as portfolio money managers, and so I'm glad to be able to offer my learnings to the women in our community. We are a certified B Corp. For those of you who have not heard about B Corps, it's a process that a business goes through to look at your overall values as well as your profitability. So profitability really is second. With a certified B Corp, you're looking at things like your community impact, your social impact, your environmental impact, how you're managing the money, your communication with clients. Other B Corps in the Richmond area are Impact Makers, Elwood Thompson's, Roberta Designs, and some of the more global, the national ones are Eileen Fisher, Athleta, Ben & Jerry's, and Patagonia, which you may be more familiar with. We became a certified B Corp kind of as an extension of what we're already doing. It's a very interesting business model. We are held accountable by a third party to make sure that we're doing what we say we're doing. And so if you don't know about B Corps, there is a great website where you can learn about supporting these businesses if that happens to be of interest. The website is bcorp.net, and you can find the local B Corps on that website. So again, I'm local, we're small, we're fee only. We have a custodian, but we're not affiliated from a regulatory perspective with a big box custodian. So that gives us the ability to focus on values and not necessarily on just profitability. We are focused on being intentional with our investments, with a degree of corporate social responsibility interwoven into it. But what most people are most interested in today's market environment is what I learned on Wall Street and how I'm managing our client portfolios through weathering the storm. So we're going to hone in on the Wall Street experience today. So for today, we're going to talk about three things. One is defining bear markets. It looked like most of you knew what a bear market is, but I don't want to make any assumptions. So we're going to talk about what a bear market is, what a bear market rally is. And a rally is just when the stock market is going up after selling off sharply. We're going to talk about that and how it relates to today. And then we're going to talk about managing risk, what it is, and some tools you can talk to your advisors about applying. So I do have to, before I start talking, I have to put my disclaimer out there that nothing I say is intended as advice. It's intended to be educational only. And so just want to stress that please don't go off and buy and sell equities based on this presentation. So let's start by defining a bear market. So a bear market and a bull market are common industry terms. And bear markets, if you look historically, they're typically defined as a 20% loss or more in the stock market. And today I'm going to use two indices to talk about the stock market. I'm going to talk about the Dow Jones Industrial Average because it has the most history. It was established in the early 1900s. And then the S&P 500, which is another basket of stocks, 500 stocks that the industry started tracking in the 1950s. So the peak to trough loss matters. what typically, well, let me start with that. The peak to trough loss is the peak of the market, the top, to the bottom of the market, the trough. So over the course of history, we've had 4 peak to trough bear markets of greater than 49%. So we had the 1929 to 32 crash, where the Dow Jones lost over 75% of its value. And then the subsequent 3 were just over between 49 and 57%. The 2007 and 2009 was close to down 57%, again from peak to trough. So this is just a picture. Rather than just putting words on a screen, I thought I would share the history. Again, the Dow Jones starting, again, a basket of stocks, 30 stocks, and this index is what creates this price line. So the green lines are bull markets when the stock market is going up, and the bear markets are the red lines. So just from context, you can see that throughout history, we've had bull and bear markets. I mean, I feel like for those on the call, you know, we have weathered quite a bit. I mean, we had a really bad bear market, obviously, from 2009 to, 1929 to 1933, where the peak to trough loss again was over 75%. And then it took 25 years, if you'd invested at the top here, 25 years just to get back to your starting value. And then in the 70s, we had another peak to trough loss of about 50%. And then we get into the roaring 80s and 90s, and we've had a really rough sledding since 2000. I mean, we've had the peak to trough loss of the dot-com bubble bursting, and then again the financial crisis, and here we are today. We are not down 49% yet, though. So, and we don't know where we're going to go from here. So I'd love to think my crystal ball could tell you that, but no one knows. So how do you measure a bear market? It really does matter how you measure. So most everyone opens their statements, maybe not that frequently. I would encourage everyone to look at their statement now, because it's important to understand how you're invested. I'll get into that more later, but it does matter how you measure. And your statements often give you either a monthly view, or it gives you a quarterly view. And I'm just showing you here this quarterly view of the S&P 500 from the end of last year through this first quarter of this year, where the S&P was down approximately 20%. But you can see that doesn't really cover the peak to trough. So this next slide shows you that peak to trough. It shows you that top to bottom loss that we've experienced so far. And while it's important to look at your monthly and quarterly statements, this is typically how portfolio managers are assessing market dynamics. Is they don't really care. They care about quarterly reporting and monthly reporting from the public's view, but in terms of how institutional money managers are managing their money, they're looking at taking a lot deeper analysis than that. So the peak to trough loss, the peak was on February 19th, my mother's birthday. Birthday, Mom. And then the trough was March 23rd. So that peak to trough loss was down 34% if you had just been invested in equities during that period. So recently, in the past few days, we've had a move up, which feels very optimistic. And there are some components of it being optimistic, but it's important to understand that if you're up 22%, which is where we are up from the trough of here, March 23rd, through the 6th on Monday, the S&P was up 22%. But as you can see, this kind of gets into the strange math of bear markets. We still have quite a long way to go before we get back to the peak. So just because you lose 34% doesn't mean you have to just make 34% to get back to your starting place. So bear market rallies, and a rally is just a period where the stock market is moving up. The bear market we've hit this current recent trough, and now we're rallying off of that. That is very typical in big bear markets, and this is just showing you the S&P 500 going back to 2000, so 1998 through July 2013. So you can see this peak to trough, and these green circles are just showing you the bear market rallies, and they can be substantial, similar to what we're experiencing today. So you had a rally in March, interesting March of 01, and another one in March of 08. We just had one in March. So you have these themes. I don't know why, but it's interesting just from a data analysis perspective. But they, as you can see, they can be fairly substantial. So the phases that we've been experiencing of a bear market are fairly typical. We have discriminate selling, where the money managers are looking at last year, where we had a really healthy gain in the stock market. We had a 28% year, up 28% in the S&P. So we start getting into some of this uncertainty early this year, and money managers are saying, you know, I really want to capture some of my gains, so I'm going to sell some positions in what's called realizing those gains, capturing the gains. Then you have periods of indiscriminate selling, which we saw in March, where everyone is just selling everything. And we had what's called a waterfall decline, where it's fast and furious. And now we're in this tug of war of, are the bulls going to win, where the market's going to continue to go up, or are the bears going to win? And no one knows. So what we do in our portfolio analysis, we manage our own portfolios, and part of the process is looking at both fundamentals, what the economy, how the economy is doing, how the individual stocks are doing from a fundamental perspective, what are their earnings like. But then we also look a lot at what's called technical analysis. And there are literally thousands of technical indicators out there. I'm showing you a straightforward analysis today, just to give you some perspective on one of the many ways portfolio managers can be looking at this market. So this is going back to January 2015, the S&P 500. We have this green line, which has become what's called support. So if you just travel up the S&P 500, again, the quarterly reporting gets very tricky, because actually during this period from 2018 through mid-2019, we had a lot of ups and downs, but essentially the S&P, the market, could not consistently break above those levels until we got into mid 2019 last year, where it broke above this 300 level and rallied up. So we've now had this waterfall decline, and interestingly, the stock market found support very close to where the December 2018 low was. And so that is an example of a technical analysis approach, a very straightforward one, where the market participants, for all of their for sophistication, are also looking at some very basic places where they could start to buy again. So we have had some buying. So the question today is, will the stock market continue to move up, or is it going to break this support line and go further down? And as I said, no one knows. So assessing this support line is, and several other indicators that kind of actually line up with this support line, which is interesting, helps me assess where we are in this bear market cycle. I think it's going to be quite some time, though, before we get back up to the peak. So that peak, that's going to take, we'll probably have a period like this where we rally up and down for quite some time, assuming we don't break down further below this support line. So I get this question a lot, and it's actually a really good question, because there are times where passive investment management works, where you're just setting it and forgetting it. But there are times when that doesn't work, and we're in one of those times. And so really the foundation for starting my business was around this concept of managing risk, that you can see from January 2017, again, the S&P 500, if you had just set it and forgotten it, you would have wiped out over 3 years of profits during this period. So that's dramatic. Up here, you would have been up 45% from January 2017. Here, you would have been flat. So that leads me to discussing managing risk. So essentially, managing risk was, the answer to that was all of the above. And this next segment will walk through each of the concepts to help clarify what I mean and how it's applied. So again, going back to the peaks and troughs of the 2000s, where you're losing 50% plus of your assets, and then it takes a significantly long time if you don't sell at the wrong time, which can happen, unfortunately, where you're selling here because you're so afraid, and that's completely understandable. And then you end up missing a large part of the rally because then you're too afraid to get reinvested. So managing risk, if this is down 50%, then managing risk, this is just an illustration to say, well, if you lose 50%, you start with $500,000, then you're down to 250,000. Your new balance is 250. So you have to make 100% just to get back to your $500,000. But what if you could lose less? What if you lost 25%? Still very painful. Okay, you're down 125,000, but your new balance is now 375. So you only have to make 33%, I say that lightly because that's still a lot, to get back to your starting balance. So first of all, that takes a lot longer to get back to your starting balance, right? Because you're having to dig out from a much deeper hole. And the other component is that if you lose that money, you can't compound on money you've lost. So preserving that capital, so the more assets that you have, the more opportunity there is for compounding. So typically, the more assets you have, the more risk management you want to apply so you can continue to compound that money. So this is not our performance. The orange line is not our performance. It's just illustrating this concept of managing risk. So again, going back to this period of 2000, that if you could lose less, you smooth things out. You become the tortoise rather than the hare. So you're happy to make a little bit less than what you're hearing on the news programs, but then you're going to lose less. And you're also going to have confidence to stay in the game. That's such a big component of this, is to say, okay, I know that for my current circumstances, my investments are allocated and invested appropriately. So I had a gentleman who is a good friend of mine come to me and late last year, early this year. And I've worked with him for years. I've known him for 15 years. And he wanted to make more money because we'd had such a good year. And I was doing more of the tortoise rather than the hare. And he's hearing the stock market, listening to the news. And so he decided that he wanted to put everything in our equity portfolio and our equity, all in. And I tried to talk him off the ledge. I showed him different proposals with I have some software that allows me to show risk versus reward and what it would look like in a catastrophic loss period. And he was very convinced that this was the right thing to do because he's only a few years from retirement. So he wanted to back up the truck and make as much money as possible. So this did not turn out well for him. Unfortunately, I did call him fairly early in this process and asked him if I could reallocate his account. And he was very humble and said, absolutely. He said, he was just a really humble and constructive about his response. So it's very tempting, and I don't fault people. It's just, it is very tempting to want to back up the truck in those periods. And another story, I had a client recently, I had a few clients actually that unfortunately lost their jobs. And I've always stressed that if you lose your job or if something big in life happens, to make sure that you're adjusting your allocations, call your advisor. My client called me immediately so I could adjust her allocations to be appropriate for what her needs and goals are now. So in the past, again, this is just a shorter term example of managing risk and smoothing things out. Again, this is not our performance. It's just to illustrate from 2017 to 2020, this more recent relevant period, where if you had participated in equities, but then been able to lose less during this period, then you would have started from a higher base in terms of returning up to your previous level of assets. That's the goal, at least. So what can you do? There are definitely things you can do for managing risk. Is please make sure to review your allocations. Talk with your advisor. Sit down. As scary as it can be, as overwhelming as it can be, it's really important. This situation may get better quickly, but the longer this has gone on, the more I have read from people that I really respect that this situation could get substantially worse from an economic perspective. So there have already been discussion about recession and the implications on the overall economy have already started to show up. Unemployment went from 3.5% up to 4.5% just in the matter of March, in the period of March. I think I am very grateful we have a proactive Federal Reserve who has provided some support to small businesses and nonprofits. I don't think it can get here fast enough. So add a component to active management to your investment approach. Passive management works great in bull markets, and active investment management is one of the tools you can use that you could talk to your advisor about for managing risk in bear markets. Diversify your investments and use options. I've certainly have used those in the past. They are great tools, but they're difficult to implement. They're complex. So, but they are a tool for those of you on the call that are interested in that kind of analysis and work. So we're watching the economy. We're watching what quarterly earnings, which will start to be released think a couple have come out this week, but next week is when really companies start to report for the first quarter. We expect the second and third quarter to be more telling because we really only got into this pandemic during the first quarter. We're looking at various technical indicators and research sources. I do that pretty much every day anyway. That's part of my process. I just touched on earnings seasons, and again, the next 2 to 3 quarters will be telling. So again, this is kind of repeating what I just said, but review your allocations. Do you have enough risk management strategies in place? And if you don't, it's okay. I mean, it's not too late. I think women, I see this in my practice, that women tend to be such natural risk managers, and men tend to be natural risk takers. Now that's a broad statement, and certainly there are exceptions to that, but women tend to want to preserve and protect. And so this is an opportunity for you to look at how you're protecting your assets in your nest egg. And then work with your advisor to determine if you have cash on the sidelines, when would be a good time to invest that cash. And so your advisor should be able to help you with that. So with that, I'm going to finish up and thank everybody for their listening.
Roberta, thank you. We're going to start taking a couple of questions, but just to kind of pile on a little bit, you had commented about it's not too late to revisit and to question your strategy. And I do think that women do have a tendency, we don't want to bother people. We don't want to overreact. And I know I shared with you that, I've been in the banking field for 35 years and I'd always been so close to the markets until I left banking last year and formed my own company. And about 2 weeks ago, I kind of woke up in the middle of the night in a cold sweat, worried about, what have I done with my portfolio and what's going on? And I put a phone call in immediately to my advisor. I am hoping that everybody on the phone has that good financial advisor that they can rely on. And don't be afraid to pick up the phone and call that person and say, let's go back and revisit my strategy. Is it the right one now, knowing what is going on? So see, do we have any questions? It appears that we do. This question is, what are your thoughts, Roberta, on annuities? I was talked into one several years ago, but I'm not contributing. Should I try to get out of it?
So I have fairly strong opinions on annuities. I can't give you advice specifically. I'd be happy to look at what you're in if you wanted me to review what you have. But I can say that annuities are often sold during these types of crisis periods, and they tend to be expensive. They are great for the advisor because the advisor is typically getting a very nice commission, and they end up locking up the client for what's called the surrender period, where you have to pay a penalty to get out of an annuity. I am not a fan. I have never ever suggested that a client buy a new annuity, as I've spent a lot of time trying to support clients in getting out of expensive annuities into something that's more, we do have an option that is less expensive that can still provide that wrapper so the client doesn't have to pay a big fee to get out of the annuity. But I think, I'm just not a fan. I think there are other ways to address that goal of cash flow and steady income. And it's not to say that years and years ago, there were annuities that did seem to have a couple of features and benefits. That was back in the 80s. So I would just be cautious if you are being approached to purchase an annuity. If you do have one, then I would suggest reviewing it with your advisor and making sure that it's still the right fit.
Fabulous, fabulous. Are there any other questions?
Thank you.
Do we have
question.
any other questions? I will say, as Roberta, as you were just talking, like a little pop-up on my screen said that the Dow is rallying today up 250 points.
Yay, that's good.
It is good. It is good.
It's good.
Any other questions? I saw somebody say, thank goodness.
Yeah.
Any other comments or questions?
Well, thank you, Gail, for this, and thank the participants for attending today.
All right. Well, thank you, Roberta. Thank you for those helpful and insightful comments. And I hope you'll join us again sometime. We'd like to revisit the finance topic several times over the next few months, and hope to have you back on Let's Talk. So
Great.
to our listeners, this session has been recorded, and information on how to access it will be sent to everybody as a follow-up. If you would like to share it with friends, please feel free to do so. Next Wednesday, April 15th from 9 to 10, we're going to have a panel discussion for nonprofits. So anybody who's in nonprofit leadership or anybody who is on a board, I think you'll find this one very, very helpful. We have speaking on our panel Martha Quinn, who is Executive Director of Development for Massey Cancer. Candace Mraz, who is President of Mraz and Company and co-founder of Free Horse Arts. And Aaron McClung, who is Vice President and Senior Philanthropic Specialist for Wells Fargo Private Bank. They're going to talk about how nonprofits can use these challenging times to create opportunities for funding, including a discussion on the CARES Act and its impact on nonprofits. We'd also be interested in hearing from all of you on the phone today any topics that you would find of interest. So if you have a topic and you'd like to suggest it to us, please visit us at www.lets-consult.com and fill out the contact form. In closing, I'd like to thank everybody for joining us this morning. Roberta, again, a very special thank you to you. And I wish all of you to stay healthy and safe. Thank you very much, everybody. Bye now.
Bye.
Bye.